Breaking news. The United States has just lost its last top-tier credit rating. Moody's, the final major agency to hold the U.S. at AAA, has downgraded America's credit score to AA1. This move has sent shockwaves through global markets. But here's the twist. OCBC, one of Singapore's leading banks, remains positive on U.S. investments for the year ahead. So, what does this all mean for you as a Singaporean investor or consumer? Let's break it down. First, let's get to the heart of the news. Moody's downgraded the U.S. credit rating from AAA to AA1, citing ballooning government debt and rising interest costs. The U.S. is now officially no longer rated at the highest level by any of the big three agencies. The downgrade comes after years of warnings about America's growing fiscal deficits and the inability of its government to rein in spending. This is a big deal because the U.S. government's credit rating is a benchmark for global finance. When it slips, it can rattle markets everywhere, including right here in Singapore. Why? OCBC's analysts point out that the downgrade, while headline grabbing, is more symbolic than practical, at least for now. The U.S. dollar is still the world's reserve currency, and U.S. Treasury bonds remain the go-to safe haven for global investors. Even after previous downgrades by other agencies, demand for U.S. assets has stayed strong. OCBC believes that the U.S. economy is still set to grow, especially with pro-growth policies expected from the new Trump administration. They even upgraded U.S. equities to overweight, expecting corporate earnings to get a boost from tax cuts and deregulation. Now, what does this mean for you as a Singaporean investor? If you have U.S. stocks in your CPF investment account, or you're holding U.S.-focused unit trusts, this news might sound alarming. But OCBC's view suggests you don't need to rush for the exit. In fact, they're advising clients to stay invested in U.S. equities, while being a bit more cautious on U.S. bonds, since rising yields could mean lower prices for existing bonds. For those with a diversified portfolio, including Singapore blue chips, Asia, ex-Japan equities, and some exposure to U.S. markets, the message is to stay calm and stick to your long-term plan.